Such a small issue, and yet the market felt the shockwave of fragility and volatility. The stock market is simply not prepared to deal with any shocks. It hadn't even closed down 2 days in a row in such a long time. The mantra of constant and never-ending buying of the dips will need to take effect in short order before panic sets in. You came here for the truth, so let me unveil that for you. Today we are going to look at the economic indicators, beginning with this. In every major market shock since 2013's taper tantrum, the central banks have stepped in, even if verbally, to protect the markets. Following the Brexit vote, markets no longer need to hear from the central banks as they rebounded so quickly that central banks didn't need to respond. Buy the dip has become a self-fulfilling put. And you'll see here as they outline every instance where this has been happening. And then more recently, it just goes up on its own. The market doesn't even come down a hair before finding its way back up again. This is not a normal process in markets. They would be falling and they would find a support level and they would go higher. But there is no support level. It's just a constant state of cycling upward and upward and upward. So what we have here, and I'm not going to get into all of it, it's too long, but essentially the fact that the central banks would normally be there to buy every single time it fell to a certain level. They would know when and they would activate. But more recently, they don't even have time to get in there because they're buying the dips. Investors are getting in there in the fear that they will not be able to get in at that lower price point. Now the VIX has increased quite significantly. I mean, not on a historic basis, but in the recent past, it has come up quite a bit. And we are looking at the VIX around 15 at its highest point. The EU VIX and the US VIX are now quite correlated. So you're seeing that here essentially to about the same at the time of this recording. It's approximately the same anyway, but what you're seeing here is that over time they may sway back and forth, but at this time specifically the markets in terms of their volatility are quite corresponding. They are all interconnected regardless. Now it goes without saying, but the consumer confidence, this is the expectation stock price of increase. Imagine they ask these individuals, do you think the stock market will rise? Yes or no? And look where it has gone since the financial crisis. Of course they will rise. There's no doubt about that. And particularly over the last few years, it has just gone straight through the roof because everybody knows that the central banks will be there. They know that there's consumer confidence out there. And there's simply this lie that we've been told that will get people into this mode of buy. Unfortunate that there isn't the underlying fundamentals that would normally be there prior to this financial crisis. Something very odd is going on. This is a very good comparison here. I've shown you something similar. Personal savings rate as a percentage of the DPI and the consumer confidence. Look at where it has gone. Completely diverging over these past few years. Guess when you saw that before? Financial crisis and dot-com boom and bust. That divergence happens every time. Doesn't mean there's a crash. No, it doesn't mean there's a crash coming. But what it does tell us is that we are entering into the same phase that we've seen before. So the market is signaling all these different things. Look at what's happening with the bond market. It's going on now very briefly, and maybe I should get into that now. What you're seeing today is because of Amazon, JP Morgan, Berkshire. They were all coming together, forming a company, supposedly with good intentions, which I find laughable. But one announcement sends the market down, and the effect of which was felt practically globally. Is that realistic? Or is that profit-taking? Is it just fear? There have been so many things since March of 2009 which should have sent the market down significantly. But it just brushed it off like nothing. And now they make an announcement forming a corporation, which of course would put some, let's say, some extra load on some companies, or maybe I should say lessen the load on certain companies, do some damage. There's no doubt, right? But that happens all the time. New technologies come on board, new companies start taking the lead. This happens all the time. The markets can shrug that off, right? But not in this case. Something weird's going on. Just think about how many very, very serious things have happened since March 2009. Maybe even, let's say, from 2013 until today. There have been many things that should have at least temporarily brought the markets down to a, let's say, corrected phase, maybe 10%. And the market just says, no big deal. To me, something's up. Okay, something smells fishy, as they say. Household net worth as a percentage of disposable income versus the savings rate. You're seeing that same divergence that is occurring here. Look at this and just think to yourself, people can't really spend any real money. They're pushed to the max. You know, I've talked to so many people, and I find it very odd, for me anyway, that people will spend, they will invest in retirement accounts when they're holding balances on their credit cards, when they're borrowing money left, right, and center. So you're going to invest to something you need to redeem 30 years from now. You're going to put in every month, right? Dollar cost average, every month I'm going to invest in my 401k RRSP supers, right? I'm going to invest in that. Meanwhile, I'm carrying a balance. Meanwhile, I have a mortgage. Meanwhile, I have financing on my car. Meanwhile, all of this debt every month that I'm paying, all that interest I'm paying. Why not get rid of all that now? Because I know over the next, whatever it might be the terms, let's say 5 years to 25 years, depending on the item. If it's credit cards, you know, maybe you're holding that balance for 3 months, maybe it's longer. Some people just hold it indefinitely. You're paying all that. Just get rid of it. Sure, if you don't have any money to pay off any of your debts, whole different discussion. Not talking about that. I'm talking about the average person working a 9 to 5. There's 2 people in the family, maybe one person bringing in the income, and yet at the same time, they are investing in retirement accounts, or maybe they're buying stocks or anything else. Why are they doing this? Doesn't make any sense. The amount of credit card debt that we're seeing today, the student loans, we're talking about trillions and trillions of dollars, and this is not a very good sign. At the same time, we're seeing margin on stocks and basically on the different financial assets that are just expanding to new and new levels. Do you not see a small problem ahead in the future? Of course not. The stocks will always rise, right? All right, the divergence between the actual household income and the income needed to buy the median-priced home. And this is one of the most important factors. I talk to people in the industry, and they will tell me to shut up. Well, it's okay. I'm used to it by now. Just look at the comment section below. There will be about 5 or 10 of those same comments. Nationally, negative 6% here. But look through this and you get the idea. Whether you're in LA, San Fran, New York, San Diego, Miami, Boston, Detroit, anywhere. People don't get paid the amount that they need to buy the average home. Guess what? That's a big problem. If you were getting paid, let's just say, $20,000 a year, but the average home in your area cost, let's say, $50,000. Well, that's pretty good. Maybe on a national scale, you're not really making that much money. But in the area you live, that makes sense. But if you look at certain areas, we're talking about 10 times or more the median income. 10 times or more. And that's US, that's, Canada, tons of places. All of the ones that I've covered here regularly. What's the result of all this? How are you going to fix this? The prices keep going up. I'm noticing that prices have risen on homes. Guess what though? Wages, stagnant, or in real terms, when you factor in inflation, they've gone down. There's no way that this can be fixed, that this will be resolved by central banks printing money. But I'll tell you something. The central banks have been giving money to their friends, and their friends have been maintaining power and making sure that they use enough inflation so that as the years go on, you barely notice it, but you're becoming more and more poor. And then every so often they purposely cause a crash to make sure anybody who was trying to get wise to the system and invest in assets, they push them down and they stomp on their face. People don't recognize the pattern. But I ask you to zoom out, take a pad and a paper, zoom out, and just spend 5 or 10 minutes to figure out how the system works. Do it. 99% of people will not. But I've done this on many occasions. Just stop, move everything away, and just think. What's going on here? What's this plan? And then you start piecing the puzzle together. And then maybe you put it aside for today. And you come back to it tomorrow. Maybe you come back to it next week and you start piecing that all together. And I assure you, if you take that time aside to move out all the media away, whether it's coming from this site, whether it's coming from books or, some financial guru, take the time out to just try and figure it out for yourself. You'll learn a lot. That's all for this video. If you found it informative, please give me a thumbs up. If you hated it, give me a thumbs down. Last but not least, if you found this video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books at Amazon. And if you want the audiobook version of Global Economic Collapse, that's at my website, themoneygps.com. So you can check those out. Links are in the description below. Take care.